event today. My name is Corey Verkonich, and I am the National Cannabis Industry Leader at Marsh Canada. The subject of today's webcast is protecting directors and officers in times of distress in the cannabis sector. I'll start off with a few housekeeping items. The webcast will run for approximately 60 minutes. We'll have a panel-based discussion for the first 45 to 50 minutes, followed by 10 to 15 minutes to address any questions, including those that we received through the online registration process and those that were posted during the session. We've already received a number of questions, but we nevertheless encourage you to ask more throughout the presentation. Just click on the Q&A icon at the bottom part of your screen or on the panel to your right and type in your question. Because this event is a panel discussion as opposed to a presentation, there will not be any content slides that we will be advancing. And finally, in a further effort to make this webcast as interactive as possible with you all, we will provide some audience polling questions and the results will be shared live. What's clear is that we are in a period of distress for directors and officers of publicly traded cannabis companies. Developing industries tend to see more volatility to their business, and this dynamic has been exacerbated by the global pandemic. We've now seen significant claims activity against the sector, and plaintiff firms are actively targeting public issuers in the cannabis space. Cannabis company, we've now seen significant claims activity against the sector, and plaintiff firms are actively targeting public issuers in the space. In general, securities class actions have sustained record levels for the past few years, both in Canada and the US. And this is having a profound impact on the broader D&O insurance marketplace. Cannabis companies have accounted for a high percentage of these class actions, and particularly in Canada. US listed Canadian LPs have largely borne the brunt of this increased scrutiny, and nearly every one of these companies have now had a securities class action within the past 2 years. In addition to the challenging claims environment, D&O insurance for capacity for cannabis companies continues to be in short supply. The claims activity and financial challenges of certain companies have caused some insurers to exit or significantly limit their coverage offerings and capacity while narrowing their underwriting appetite. The objective of today's discussion is to help provide an understanding of the conditions within the insurance and cannabis industries that have created this situation. I hope we will also provide insights into how cannabis companies can make themselves more resilient by understanding the underlying causes for some of the claims that we've seen in the sector. We will discuss some of the internal processes, checks and balances around regulations, and disclosure practices that can reduce the likelihood of facing a claim and also make the risk more attractive to insurers. To better understand the claims environment, insurer considerations, and legal and regulatory concerns, we've assembled a panel of legal experts and an experienced cannabis D&O underwriter. Each panelist brings a unique perspective to the discussion, and I look forward to what they have to say. I'll serve as a moderator for this discussion. So now on to the introductions of the other panelists and their credentials as they relate to cannabis industry D&O liability. Firstly, Laura Jackson is a partner in the advocacy group at Castles and is chair of the securities litigation group. Laura is a member of the firm's executive committee and serves on the Advocates Society Securities Litigation Executive and the Ontario Securities Commission Securities Proceedings Advisory Committee. These roles speak to her expertise in class actions and securities litigation. Peter Horban formed Ascot's management and professional liability platform in January of 2019. He joined Ascot from Aspen, Bermuda, and brings over 14 years of underwriting experience. Prior to Aspen, Peter was the managing director of Chubb Atlantic Indemnity Limited, overseeing Chubb's Bermuda platform. Peter began his career in Canada with Chubb and W.R. Berkeley, and is a graduate of Queen's University with a Bachelor of Commerce. And I can attest to Peter's Canadian roots because before he departed for the Sun and Sander Bermuda, we played hockey together. Robin Campbell is the Senior Vice President, FinPro Claims Advocate in the National Claims Advocacy Practice at Marsh Canada. In this role, she helps clients navigate their D&O insurance in the face of complex claims, including in the cannabis sector. Immediately prior to this role, she was Vice President, Specialty Casualty Claims for Liberty Mutual Canada, where she works since 2012. In this role, Robin managed a team of lawyers and other claims professionals handling a wide variety of complex D&O and other financial lines claims. And before joining the insurance world, Robin was in-house counsel at Toyota Canada, and prior to that, an associate at Castles. Robin was called to the Ontario Bar in February of 2002. And one final comment before we begin. On behalf of all of us here today, I'd like to wish a heartfelt thank you to all the frontline and essential workers everywhere. We appreciate the risks that you take for the benefit of us all. So with that introduction, let's begin our discussion. And to set the stage, Robin, I'm hoping that maybe you can provide a little bit of background as to what's driving the current claims environment in the cannabis sector, and speak to some of the causes of actions, allegations, lost drivers, and so forth.
Absolutely. Good afternoon, everyone. You know, my knee-jerk reaction to that is the opportunistic plaintiff law firms, but it's not that simple. Certainly, that is part of it in terms of what is driving the claims environment. In addition, obviously, this is a nascent industry still, even though we're now 18 months plus past legalization federally in Canada. It is still in its infancy. And as a result of that infancy, in addition to sort of greater stigma, if you will, I don't think that that's got a negative connotation. I don't think it should, but the sort of the concerns that sort of the greater population may have means that the regulatory spotlight or target, if you prefer, is very real. That combined with an excruciatingly slow rollout, which for many of the participants this afternoon, I know experienced painfully, because of course that slow rollout meant that growth plans targets were blown out even from the get-go. Additionally, you know, things like short seller reports or press releases about regulatory inquiries, those things are all what we see in terms of driving the claims environment. In terms of causes of action, you know, as every claim is of course unique, as every set of circumstance is unique, but we're seeing certainly some patterns, both because there are some plaintiffs firms who have set themselves up as the firm to pursue this, and also just because there are some similar issues that many of the companies in the space are facing, some of which my friend Lara is going to address shortly. In terms of the sort of typical things that we're seeing, I've categorized them into four buckets. So first, and in virtually all, you see allegations of materially false or misleading statements, or the reverse of that is omission of material information. So, you know, this is the disclosure failure, and disclosures for publicly traded companies are incredibly important and fundamental, and that is the key part that plaintiffs counsel, as soon as they get interested in something, the first thing they're looking at is what are the disclosures say? You know, what did the press release say? That's the digging that they do initially. The second bucket of allegations that we see center around inadequate controls in place internally, and that can be argued or alleged in a number of different ways, including things like undisclosed related party transactions, that kind of thing. Thirdly, and this has been quite common, we see allegations over misstated inventory and production targets. And then lastly, we have seen, and this is tied in with being such a highly regulated industry, that basically a failure to comply with those regulations, whether it's unlicensed rooms, for example, or any other sort of offside of this very, very strict regulatory environment, we're seeing that being pled in these actions. Lara, did I miss anything there that you'd like to add?
No, I think you've described the class action claims well. And like you said, Robin, whenever there's some kind of sharp decline in share price, the first thing plaintiff's counsel will do is comb through disclosure to look for omissions or what they can try and represent as misrepresentations that were somehow corrected through the disclosure that led to, you know, the decline in share price. And that's how they found their claims. So the disclosure is really, it's really out there. It's a minefield for the plaintiff's counsel to go through and just try and hook into something. And we'll talk a little bit more about disclosure later, but it's of critical importance for that reason.
Yeah. So certainly the first issue is volatility with share price, and then secondarily the potential for some of these disclosures or missteps on behalf of the company to be exploited by the plaintiff firms. Robin, in your role, you're seeing the claims process unfold. I'm wondering if you can maybe provide a little bit of comment around, how you're seeing these claims unfold in the cannabis sector, in particular, and also how the D&O insurance might be responding, if it's responding to these claims, and any lessons learned, so to speak.
For sure. So short answer, are the D&O policies typically responding? Yes, typically they are. That does not mean that there aren't coverage complications in certain files. There are, as in most D&O. D&O is one of the most complicated areas, I think, of insurance, and in this space, it's no different. And so from a process perspective, I would say, a securities class action is a securities class action. But there are nuances to this space that I think that are important to remember. But yes, typically, if the claim fits within the insuring agreement, and there's entity coverage, for example, the side C, to use insurance lingo, because it wouldn't be a seminar without me doing that. Then we're seeing those coverages being extended because they've been paid for, and it's a promise to pay. But they will be subject to firm reservations of rights, which for everybody's who hasn't had to receive one of those, it's basically the carrier saying, right, triggered, there's coverage, but A, B, C, D, E, whatever it may be. So we're covering you, but in the event that it turns out you're a fraudster, we're not covering that. Or in the event it turns out, it's personal advantage, we're not covering that. But the coverage for defense costs, which frankly, in this space, the defense cost is a huge, huge part of it. So even if you've done nothing wrong, which is what I always believe of my clients, is that it costs you a lot of money to prove that, as aggravating and frustrating as that can be. So, you asked, and I'm mindful of the time, and there are two much more important people that people want to hear from today. But what I would say, D&O policies are claims made and reported policies, which is lingo for don't dawdle. Get your claim over to hopefully your sophisticated broker, have the discussion, and get that noticed. As our friend Peter is going to be describing to you, and as is no surprise again to the folks on the phone, this is a hardening market like we haven't seen in 20 years. And so there has to be strategic decision making between a client and their broker about the best approach in terms of noticing the carrier, And I would encourage that communication as quickly as possible. The sort of final takeaway, if you'll grant me just one more minute in terms of
Absolutely.
What do I think the lessons that we've seen coming in and sort of going through this with different clients. The first part is sort of before a claim even happens, in that magical time, read your policy. They're long and they seem like run-on sentences, and surely this is not even English that I'm reading. Please, I encourage you, read your policies, understand your coverage, and if you don't understand it, no harm, no foul. That is what your broker is there for. It's your broker's job to explain what is there and what is not, and have those conversations so that when you find yourself in a claims scenario, which is a is a stressful, high stress situation when you've been served with a claim, typically Friday afternoon before a long weekend, then you sort of have a general sense so that your own personal comfort as a director or officer of one of these companies is a bit better. And then in the claim scenario, again, be mindful of the space in which you are operating. So if you are coming up on a renewal, for example, and you get sued usually a week before, because that is Murphy's way, figuring out the appropriate way to handle that with your carrier, because they are somebody you're going to partner with. If there's coverage, you need to have a working relationship with them, but there are strategic considerations that are important and worth having that conversation with your broker.
That's great, and I think the one thing that I would add there is you mentioned read the policy. Some companies or some individuals may have virtually no familiarity with the D&O insurance policy. And so that's really, where the broker can come in and help guide them, help understand, what they need to look out for, what aspects of the policy are important, where there is variability from one policy to the next, what's standard, that sort of thing. No, certainly some good comments, and I'd probably underscore the comments you made around the claims made policy, understanding the claims made nature of the coverage, and some of the strategic decisions that need to be made with respect to notification when incidents may arise, how the timing of the renewals, all those sorts of things really do come into play. So yeah, thanks for your comments.
Pleasure. There is one question which we certainly will answer. I think it's really important about potential bankruptcies in the space, but we can maybe handle that at the end. We'll certainly remember to get back to whoever asked that. It's an important question.
Definitely. Yeah, thanks for the question. We will address all the questions at the end. So just switching gears a little bit and just looking at some of the legal considerations and more from a risk mitigation standpoint after, sort of looking at the claims environment. So a question for you, Laura. One of the things that Robin mentioned was around, the fact that cannabis is a highly regulated industry, and that some of the claims do relate to the regulations as set out by Health Canada. Wondering if you have any comment in your experience around, policies and procedures that companies should implement to potentially avoid regulatory breaches and non-compliance that, could later, serve as a basis for an action if there was, a potential investor loss.
Certainly, and thanks for inviting me to be on this panel, because it's a really obviously exciting area. I bring the perspective of a defense counsel to this discussion, having defended numerous class actions, securities class actions, including in the cannabis space. And as a defense counsel, class action lawyer, I always look at how could this have been avoided. We end up with the situation that we end up with and put forward the very best possible defense that we can for our clients. But on the other side of my firm, which is the corporate side of cannabis. They're the ones advising companies on how to avoid these situations in the first place, which certainly is preferable. So looking at kind of some of the policies and procedures that can help prevent claims or to provide the best possible defense when claims happen. As Robin mentioned, it's a really emerging new industry, and it has unique challenges which relate to the nature of the product, the nature of the financial reporting, as well as the highly regulated nature of the industry, including both domestic and international regulations. And the starting point for policies and procedures, even before we get to policies and procedures, I think it's really important to talk about the critical necessity of having a qualified board. And many of these companies were formed in early stages by founders, directors, who no doubt have complete expertise and experience in the cannabis area. But many of these issuers are now finding they're at the stage where they may need to expand their board composition to include board members that have experience in corporate governance and securities and regulatory matters, and that could be from different industries as well. And having said that, and recognizing the importance of having external and new board members, and in fact, the Canadian Securities Administrators have talked about the importance of having independent board members and as many as possible in the cannabis space. We recognize it can be really difficult to attract board members to this industry because it's new, because of the risk factors, and because, as Robin mentioned, and we're discussing here today, because of the volatility and the high number of claims that are being advanced. So we wanted to have our first poll here to ask people who are on this seminar, and we're going to read the results afterwards. Have you had difficulties attracting board members because of personal liability concerns or insufficient D&O limits? I'll give a minute for the polls.
Yeah, and the answer is either yes, no, or not applicable. So we'll give a minute for everybody to. Oh, I think we've got the wrong polling question coming up first. Sorry, just bear with us for a minute. There we go. So we'll just give a minute for everyone to answer that, and then we'll show the results. But I think this this really speaks to the heart of the discussion here today, and the theme of the webcast, which is the distressing times that we're in. So okay, so we've got some polling the results in now, and of those who answered, 6 indicated yes, 2 indicated no. So I think, certainly, Laura, I think you can take away from that answer that that it is an issue for the industry. And, and the thing that I would say about that is that, different companies are at different stages, right? You've got companies that are quite, more sophisticated and advanced, and they may be further along with respect to having a more qualified board, but you're going to find companies, at all stages along that spectrum.
Yeah, and as this poll indicates, part of the difficulty can be because of D&O limits, which Robin and Peter will be speaking to more than I will, but part of it is also personal liability concerns. And personal liability concerns are obviously addressed to a certain extent by insurance coverage, but also more preventatively, they can be addressed through good and robust corporate governance policies and procedures. And I think that directors are going to be much more attracted to serving on boards that already have a good governance process in place. So I just wanted to speak to a few of the policies and procedures that we recommend having in place to help, prevent, as I said, or defend claims. And most companies, when they are incorporated or when they go public, they will have had policies and procedures put in place by their external law firm at the outset. But it's not enough to just have the first policies put in place and assume that those are going to be good to go. It's important to review them on an ongoing basis to ensure they're comprehensive and that they're being followed. Being followed involves regular training, both onboarding for new executives and regular training for existing executives and employees, and creating a culture of compliance, but also looking at policies as the company grows and expands, and tailoring the policies to the company's needs and risks. Some of the key policies that should be in place and should be looked at are the more regular corporate governance policies like insider trading, whistleblower policies, code of ethics and business conduct. But a little bit more particularly to this industry, anti-corruption and anti-money laundering policies are of really critical importance in this industry, and it's not readily apparent always, but because of how companies in this industry operate both in Canada and overseas, it's very important to understand where, in which jurisdictions, for example, recreational cannabis is legal and which ones they aren't legal, because you can get into a situation where proceeds from illegal activity in Canada, to the extent they're used overseas in a jurisdiction where the same activity would not be legal, you can get into all sorts of difficulties with anti-money laundering and corruption violations. Conflict of interest policies are also really critical in this space. The Canadian Securities Administrators have been looking at various issues with cross-ownership of cannabis companies because of it being an emergency industry. They've identified concerns with directors and officers having ownership positions in other companies in the space and not disclosing them. As Robin mentioned, their short seller attacks are very common in this industry, so it's important to have policies and procedures to deal with that. And finally, in terms of the highly regulated nature of the industry, it's really important to have robust policies and procedures there and a designated person or team to ensure compliance. And it's a best practice for that person to report directly to the board so that the board has an open line of communication to compliance with these various policies. Because as you said, it's highly regulated, not just domestically, but you have to worry about US regulations, federal, state, and then all other jurisdictions where the company operates. And it just creates a huge minefield of potential areas to trip over that can lead to claims.
Yeah, I would certainly underscore that point that you made, Laura, about having the independence of, you know, the person who has oversight from a regulatory perspective, you know, having that direct line into the board, because it just maintains that independence and you know, avoids the potential for, you know, a perhaps you know, a negative culture where, you know, there's other priorities that are, you know, paramount as opposed to, you know, that sort of transparency, and you know, and doing the right thing. So thanks very much for that. One of the other areas where, you know, we talked a little bit about you know, some of the underlying actions to claims relate to, you know, disclosures of material information, misrepresentations, omissions, and public disclosures. I'm wondering if you could provide a little bit of commentary around, you know, how companies can address potential weaknesses in their disclosure practices and some of the best practices in that regard.
Sure, happy to. And there's really two pillars there, which you mentioned. One is timely disclosure of material changes and ensuring that the company's disclosure is comprehensive. The other is to avoid selective disclosure. And I'll talk both about those briefly. In terms of the particular challenges facing cannabis industry, because of the way that this industry was started, the fact that it's an emerging industry, and the fact that, as Robin mentioned, we've only had legalization for 18 months now, many of these companies were valued based on forward-looking projections and forecasts and multiples of EBITDA. And these companies also regularly provide guidance, maybe even more so than in other industries. And this gives rise to a lot of disclosure concerns because that forward-looking information and the guidance that's out there is something that investors can claim to have relied on. And to the extent that companies are not making their projections, but are rather missing them, it's really important to provide timely disclosure of those developments. Otherwise, you can see class actions coming down, and it's not always in our nature to want to disclose bad news, because obviously we want to put out a presentation of success, but disclosing the bad news as it happens is so much better than hoping it gets better, disclosing it down the road and opening up to claims. Another really important factor for cannabis companies' disclosure is disclosure of risks, because there are many unique risks in this industry, including, as we discussed, the regulation from domestic, international, and there's various cannabis-related disclosure risks as well, which the Canadian Securities Administrators have put out in some of their statements that relate to. Yeah, sorry, go ahead.
Sorry, just to interject and just to add to that, that the investor community for cannabis companies may not be as aware of some of those risks because it's a new sector for them as investors as well.
Exactly.
Interrupt.
I think for that reason, it's important to, if anything, over disclose the risks. And it's not something that companies necessarily want to do when they're out there raising capital. But we see some recent examples from the US where a class action was successfully dismissed because the company had 35 pages of comprehensive risk disclosure in their offering documents. So when shareholders sued them because of the value of their investments going down, the company was able to say, you knew about all these risks when you invested because here's 35 pages that describe them. So it is really important to have that risk disclosure up front in the company's disclosure documents. It makes it much less likely for a plaintiff to successfully say, I didn't understand the risks. And I don't want to take up much more time on disclosure here, but there is a lot of guidance in the Canadian Securities Administrators Review, which people on this webinar would be aware of from right when this became legal in the fall of 2018. But this, specific issues to the industry like fair value accounting of biological assets, specific accounting policies to this industry, and as I said, forward-looking information. So in terms of disclosure policies, it's just really important to have comprehensive disclosure of risks and a process for making timely disclosure of changes to the issuer's activities and results. I also mentioned selective disclosure, and I can cover that in 2 words. Don't selectively disclose to investors or anybody else, because that just creates a whole other set of issues.
Yeah, I was gonna pick up on that actually. So Laura, you mentioned how it's preferential to provide bad news in a timely manner and give it to the investor base right away. I guess the flip side of that is over delivering on good news or potential good news, right? Where you're in a situation where you may want to overpromise, but then subsequently you may underdeliver as a result of maybe not meeting some milestones or having some headwinds that may not have been foreseen. And so I take it from your final comment that that sort of behavior is best avoided, in keeping with a risk mitigation set.
I think that's right. I mean, it's human nature to want to share good news and to obviously encourage investor confidence, but it's really important not to provide information to one and not to all. So, when companies are doing roadshows or calls, it's really important to stick to the script in terms of what's already been publicly disclosed.
Absolutely. So I want to switch gears a little bit over to Peter, and before I do, I'll say Peter is literally in the hot seat because he's in Bermuda right now, where it happens to be 34 degrees, and I understand his air conditioning isn't working right now. So if you see Peter sweating, it's not because he's nervous with the questions, but maybe coping with the heat a little bit. Peter, wondering if you can provide some context and commentary on the current D&O insurance market for cannabis companies at the moment.
Thank you, Corey. Absolutely. Yeah, sitting in front of a glass window was a very bad idea. Before we talk about what can be done about the current situation in the D&O market, I think it's worth quickly discussing how we got here. Ultimately, it's not greedy insurance underwriters. It is a very challenging market right now. and it's pretty simple. There's three factors from an underwriting standpoint that are a concern. You have the regulatory, the claims which we've discussed, as well as daily negative headlines, particularly in the last year as the stocks have got hit hard. And then you have a general hardening D&O market dynamic. On the regulatory side, we all know it. Many financial institutions have no interest in the cannabis space, whether it's legal or not. And that is certainly the case in the insurance market. Only a select group of insurers have decided to even enter this space. As I'll discuss after, I think this will change in time as the regulatory and legal landscape, particularly in the US, changes. But it is, for the time being, only a very small handful of underwriters in this space. We've spoken about the claims side of things, but just to give some stats, I have a list in front of me of 18 security class actions that are publicly disclosed against cannabis companies. And to put it into perspective, as I look right now, there's about 185 publicly traded cannabis companies between the CSE, NEO, TSX, NYSE, NASDAQ. And the more than half of them are quite small companies. So when I look at the universe I look at, I'd say about 75 of them fit into the universe I normally look at. So if you look at 18 security class actions on 75 companies, that's a 24% probability of a claim over the last year and a bit. Compare and contrast that with the 5,700 US public companies, where the average probability of an SCA, security class action, has been around 5 to 6% over the past 3 years annually. And it's pretty evident that the claims environment has been extremely challenging for underwriters. I mean, 4 times higher than what you're traditionally seeing. So that obviously has created a number of issues for some of the insurance companies in the market. To cap it all off, and I have more positives. I'm not the Grim Reaper here, but the D&O market in general is dramatically hardening. Insurance is a very cyclical industry. Post the credit crisis in 08 and 09, a lot of capital came into the market, a lot of new players started up, and the market was extremely soft with prices going down between 2010 to 2016. It wasn't until late 2016 that some of the big players started cutting capacity and pushing prices up. A number of the smaller players exited, and the prices have been going up dramatically the last few years. Unfortunately, this has only been compounded by COVID. It's yet to be seen, but the general thesis is with COVID and the financial crisis that's been brought on, there's a heightened volatility for D&O insurance. So prices are up dramatically. Another quick stat, in Q1 of 2020, the numbers range between some of the brokers that provide this. The rates were up anywhere from 45% to 105% on average. So you're seeing since 2017, the average insurance premium has at least doubled. So with that in mind, you can imagine when it comes to the regulatory and then the claims concern in this business, the average underwriter at this point hasn't looked to enter the market because on their own portfolio, they could just get 50% rate increases without having to enter a new environment. But at the same time, we'll talk about this after, that's the past. I think we should, briefly talk about where things are in the future.
Yeah, no, I think those are some good comments, and you compared and contrasted the cannabis insurance market from just the general D&O insurance marketplace, and you mentioned in the last 3 years, the likelihood of an SCA or securities class action hitting any publicly traded company in the U.S. is 5 to 6%, and I think it's worth just highlighting that this is effectively at an all-time high as well. So while cannabis companies, maybe 4 or 5 times, higher than that, we're already working off a higher base level, given that we've seen record numbers of securities claims in the U.S. In the past 3 years. First in 2017, then 2018, and then 2019 held steady at about 433 securities class actions. Meanwhile, over the past, number of years, you've seen a declining number of publicly traded companies in Canada. So that probability has just increased. And I can certainly attest to the fact that we are seeing, for traditional industries, rates hardening dramatically. In particular, the life sciences sector, which is, sort of the closest parallel industry to the cannabis sector, where things have dramatically tightened up and hardened from a market perspective.
Yeah, and Corey, if I can add one thing there.
Absolutely.
I also want to state that when it comes to the 18 SCAs that have been filed, there's first of all, there's a lot of other claims that aren't security class actions that have been noticed or hit D&O policies. We can talk about that after, but those are just the publicly disclosed D&O class actions. But one interesting trend that I've noted, and I was wrong on this, is the SCAs have not only been against the dual list or the US listed Canadian LPs, but they've also been against some of the TSXV as well as the CSE listed companies, which if you asked me a year ago, I would have thought that plaintiffs wouldn't focus as much on some of the auxiliary exchanges and more on the US or Canadian or TSX exchange, but it's been across the board. So I think it's important for people that are listening that, regardless of your exchange, even your size really, you need to have, your risk management well tied up regardless, because as was noted on the call before, plaintiffs firms are certainly targeting this space. There's no question about it. Yeah.
And, even if, and this was mentioned by Robin, with defense costs where they are, and I would imagine you have a view of this as well, Peter, that, even if you have a claim that you're able to successfully defend, the odds are you're still going to suffer a fairly significant loss that, as a primary insurer, you're likely to bear potentially a full limit loss. Any comment on that?
Yeah, I mean, I think you said it right. I mean, there's no question that it's a sad reality that we're all faced with. The loss cost inflation across all lines of insurance is really out of control. And it continues to be a major challenge that we're faced. The premiums throughout the life science, whether it's cannabis or anything, on the face of it are certainly quite high. But when you dig down into how expensive these defense costs are, particularly when you have now both state and federal class actions brought, it's certainly adding up, and it's a huge issue the industry has been facing.
And just with respect to, if I could just add with respect to class action defense costs, not to defend our bar, but it's very expensive because not only is there the cross-border class actions involves having both Canadian and US law firms work together, work collaboratively to make sure one doesn't get ahead of the other. But also in Canada, securities class actions have this leave threshold, which requires a lot of costs upfront to try and prevent the plaintiffs from even getting leave to start the class action. And it's a big upfront investment that can really be worthwhile because you can knock the class action out if it doesn't meet a very material threshold, but it involves a lot of upfront defense costs, and you don't want to be hampered from your ability to do that. So just to kind of defend why these class actions are so expensive, especially when they're, as you said, dual listed and coming from both sides.
Fair enough, Laura. We won't hold it against you that your industry.
Necessary evil.
Okay, so thanks for that. I think we absolutely painted a bit of a stark picture there, but absolutely laid it out as it is. But I think it would be, what I'd really like to do now is maybe highlight some areas that companies in the sector, might be able to do to improve their risk from an underwriting perspective. So Peter, a question for you: what things do you look for when you're, it's a multi-part question, but what things do you look for when you're underwriting a risk, and what to you makes a good risk, and what do you look out for as potentially a red flag when you're underwriting?
Absolutely. I mean, the first point of good news now that I'm no longer the Grim Reaper is, at least stock valuations, certainly we all know have come down quite dramatically. And, the stock valuation loss is obviously a key component to a security class action. So, I think I'm sure many people on this call, it's been a painful experience, when stocks got hit the way they have, but it does, from an underwriting perspective, provide a little bit of relief in terms of, the bust is over in terms of, the stocks going way up and way down. But I do think education and interaction are key things from an underwriting perspective. Most underwriters are generalists when it comes to, they'll be doing an oil and gas deal and then maybe a bank the next minute. And as much as, particularly in Canada, Cannabis still might be on the front page of the Globe and Mail a lot. I do think there's a lot of misunderstanding about the actual specifics of the business. And, I think some people still are confused between, CBD and THC. But so I think that any ability for companies and to provide more education to underwriters on what's going on, I think would be quite helpful, because again, given the regulatory concerns, every individual underwriter that, a similar sized company that's traded on the NYSE that they would have authority to underwrite themselves. Given the industry, it generally moves pretty high up the ladder for a lot of companies. So, there's a lot of questions, and these underwriters really need to understand every element of the business. So education's one thing. And the other thing, I can't say enough how important it is to have interaction with, the CEO or CFOs of these companies. Prior to COVID, as everybody from Marsh knows, I was on the road pretty much every week meeting with most of the management teams of these companies, because it is understanding what the strategy is, who they are, who the board members are, is something that I think is very important, particularly given some of the issues that have come up in the space, so that underwriters can understand how this company is different from the rest, because we all know there is many negative headlines in the space. So I do think that early on in the underwriting process, it says a lot to have direct involvement of, we all know that it's a challenging environment. We have COVID going on, but it does help to have those interactions with the senior management team to understand their strategy, the challenges that they're facing, and what they're all about. The underwriting process is quite in depth. It's across the board, but a few things that I certainly noted. We already spoke about, the experience of the management team and board members is key. It's one thing if it's, if you're growing versus if you're just marketing the product, you need people that have the correct operational experiences. There's many companies that, they need CFOs with public company experience that they don't necessarily do, but that's a huge thing we look at. We spoke about the risk disclosures. I read every K for every company to look at the risk disclosures, because it is a huge element. It's important to have everything in there. Having a regulatory discussion with underwriters is very helpful, or at least pre-preparing for it, because any assets in the U.S., given the current environment, whether it's fully legal based on the Farm Act, they just need to really be they need to understand exactly what's being done in the U.S. until the regulatory environment changes, because that's a key factor that scares away a lot of underwriters. Anything in the U.S., they say, oh, we can't go near it. So understanding what's being done in the U.S. and how it's being represented is key. And finally, we spoke about this briefly before, but the things that are certainly red flags, guidance. I think most companies have finally pulled guidance, and particularly across the board, every industry now with COVID has been given a free pass to pull their guidance. But as we've always said, when you miss guidance, it's basically a roadmap for a plaintiff's firm to come after you. Personally, adjusted EBITDA drives me crazy, but it is what it is. It's very easy to manipulate those numbers. And as was said before, the conflicts really need to be disclosed, because there's numerous conflicts throughout the industry, and you can't hide from it anymore. And finally, all underwriters are looking for skin in the game, and management teams that they prefer to see more buyers than sellers of the stock.
Yeah, no, absolutely. No, I think some really good points there, Peter. And I would also highlight the point you made about getting in front of, getting the management team out in front of insurers, letting them tell the story, show their sophistication and experience and just their mindset around running the company. I think.
And even Corey, if I jump in there, we've had many companies that have gone through major transitions, and telling the story of what, how things have changed, I think is important. I think, we see a lot of management teams that are now transitioning from maybe the founders, the entrepreneur, to more of a seasoned management team. And I do think it's, there's good stories to be told, but they need to be told correctly so that underwriters can understand the difference between, the past and where the future is.
Peter, can I ask a question? This is spontaneous and probably not fair of me, but you'll forgive me, I hope. Can you maybe address how you view potential new clients who have a loss history, who've already been dinged once before? Is it a big sort of red, forget about you, I'm not interested? Or is it, tell me your story, tell me how you dealt with it, and then I'm going to see if I'm interested?
No, I mean, I mean, as was brought up on the call before, getting an SCA filed against you is certainly not a pleasant experience. So it actually is usually a lesson learned that as a underwriter, you can look back and they understand, oh, we need to do this disclosure. I mean, I always use the same analogy with a crime loss, which I historically did a lot of. The best time to ensure do a crime or cyber policy is after the loss has already come in the door.
Absolutely.
And I think it's certainly not the same with security class actions, but there's a similar element that I do think is, I don't know if many underwriters don't look at it that way, to be honest with you.
Yeah.
The claim comes in the door, particularly in this environment where the claim comes in the door and they'll get off or cut capacity, which I find is an interesting concept, but
yeah. Thank you. Sorry to throw that at you. I was interested because I think different carriers handle it differently. Different underwriters do.
No, I think it's a good question. And one final comment I'll make about your comments, Peter. If people are confused about the difference between CBD and THC, I suggest trying them both, because I think once you do, you won't be confused about the difference for very long.
Unless it doesn't work, and then you can start a class action like the one we just saw.
No, good point. So recognizing the time, want to move to some audience Q&A. So a couple of questions came in, and the first one I think is best addressed by Peter maybe. So the question is, what are your concerns around claims stemming from potential forthcoming bankruptcies and M&As, and this is likely, driven by the current global pandemic?
It's an interesting topic, and this is more across the whole. When we talk about COVID across the board, I'm still conflicted in trying to understand the COVID exposures. We read a lot. There's been, I think, 18 COVID-related security class actions that we've noted in the past 4 months. I think it's early days, and I'm only speaking from what I think. I think it's going to be challenging for the plaintiffs bar to be able to prove the loss when it comes to, if you're forced to shut down your operation. I think it's going to be a big challenge to say, hey, the government forced us to shut down. What do you expect? It is what it is. But it's certainly, don't get me wrong, it's a huge concern for underwriters. Because similar to 08-09 and the dot-com bubble, with the market volatility, I mean, those were very painful times from underwriting shops, because obviously as soon as shareholders lose value, they sue. It's certainly an increased exposure, there's no question. At the same time, as we've seen with a number of the cannabis companies, I mean, sales should be rocketing through the roof right now. Nobody has anything else to do.
In the event, part of that question was about the actual coverage for claims happening in the distress space. It's happening. So that's, again, know your policy, right? Look at your what is called side A. Typically, that's non-indemnifiable loss. So people may often just think about it in terms of derivative claims, but it's also when the company can't afford to indemnify you anymore. So certainly, there are going to be claims coming, in the cannabis space, but in companies broadly speaking, creditors, CRA, employees, you name it. Those claims are coming, and there are protections built into CCAA and all of that kind of thing. But it's certainly something to ensure you understand and ensure you have sufficient side A limits that would, because at the end of the day, the D's and O's need to be protected, and their families, their personal assets need to be protected, and that's what that should be focused on. So just in the event, because it came in when we were doing the claim section, so I just wanted to make sure I. Excellent
point. Thanks for that, Robin. And then another question that came in. This one's a bit of crystal balling. Current trends around cannabis class action lawsuits forecasted for 2020 and 2021, slowing, accelerating. How does the trend compare? Maybe Laura, I don't know if you want to maybe take a stab at that one.
Well, I mean, in terms of the number of class actions, I think they're going to continue to increase, as we've seen every year since this industry started. And in terms of the causes of action, I think it's difficult for me to predict right now if there's anything out of the various causes of action that Robin kind of outlined at the beginning. But I think financial reporting is always going to be a huge issue in this area in terms of, as we said, guidance, missing guidance, and when actual results should have been communicated. Robin, can you think of any other trends, businesses you're seeing?
No, I agree. I think it's going to continue. That the COVID factor, as I'm calling it, is everybody is scrambling for little resource out there, so that may affect things. But I do see the trend continuing in that vein. Being mindful of the time, a third question came in that I actually think is really important to address.
I agree. Yeah,
if you don't mind me jumping right in on that one.
Please do, Robin.
So excellent question, anonymous attendee. In D&O policies where there are sizable self-retention requirements, which there are often in this space, who choose the firm to handle the defense? The answer could help manage the underlying defense expenditure. I'm guessing that might be a general counsel or somebody thinking about these important things. So typically the D&O policies are reimbursement policies such that there is no duty to defend, and so choice of counsel, depending on the carrier, will be within the control of the company. You need to read your policy. It's RTFP, read the full policy. You got to remember to do that because it will be set out there. Even where there is no duty to defend, some carriers have a select panel from whom you can search. The reason they have this is they do a lot of litigating, insurance companies do, and they can get better rates. So that actually, it works for both the company who's dealing. You got a $5 million self-insured retention. Everybody's interests are aligned at keeping, sorry, Lara, not yours, at keeping the hourly rates as low as possible, because it means it erodes the retention more slowly, and so the carrier can wait to pay, and everybody gets a little bit of stretch on that. So RTFP, read the full policy.
Well, just recognizing that we're now at the hour mark, I think we'll look to close. But I firstly want to thank all of the panelists for taking the time to attend today and share their insights. I certainly appreciate it, and I expect the audience does as well. And then following that, I'd like to send out a heartfelt thank you to all the audience members that joined our session today. We truly hope that you found the discussion to be both insightful and informative. We had originally conceived of this event as a live event, followed by cocktails and a networking opportunity. But unfortunately, given the circumstances, we all can't be together right now. But we do look forward to the opportunity to be able to see you all again soon and in person in the near future. And then finally, there will be a survey sent out following the call. And your input will help us ensure that future events are impactful. So thank you once again. Thank you for completing the survey. And I hope you all keep healthy, safe, and well. Thank you very much.